Rob, how you doing?
Hey, Mark.
I was gonna say you just.
Yeah.
Okay.
Good.
We're all set.
What office are you at?
You know, I'm with Old Republic Exchange. And
Oh, that's right.
Yeah.
Yes.
Been doing that for about,
And are you in the Nevada, Grand County?
just moved up there
Yeah,
last year.
right.
Mhm.
That's right.
Yeah, so it's been, I don't know, 15 years I've been doing this,
Yeah.
exchanges. For
So,
that, a gazillion years doing escrow, so one or the
right.
other.
What are we going to talk about?
So I had somebody who's actually, I don't know where it's going to land, but I was going to refer him to you. I sat down with them. It's one of Sharon Ficinto's clients.
I know the name.
You know,
Yeah.
she's at McGuire. But they, she has an Airbnb in like part of her primary home. And now she wants the 1031.
A percentage of the
Percentage
property,
of it.
which is, yeah, that works.
That's another thing I thought maybe.
Yeah, bring that up.
Because that's like on a lot of people's minds now. So what do? You have to do with like a square footage sort of thing?
You know, it really depends. You have to quantify it. Normally, people would work with their CPA,
Okay.
and you look at the percentage of the property that.
What's
Uh,
rented
let's
versus
see.
what?
Usually, there's enough room.
Normally,
Oops,
what
sorry.
happens is they,
Do I have
on
the
their
little
tax
one?
return,
Do you have the?
they are showing.
Oh, wait a minute. You know what?
percentage
You've got number
of
3. That's why.
That's-
Sorry. Can I get you
Do you
to
want the 3 white ones?
No, you're fine with the white.
Oh, okay.
This is the one. This one belongs to you.
I think I stipulated that in my contract.
Okay.
Yes, the white one.
You're the white horse.
That's right. Okay, so how we want to do this? Yeah. Mark, why don't you start off with question number 1, which is what is an
I don't have
exchange?
anything.
I got some stuff for you. You want? Yeah. Here, take one of those. We'll just mix them up. I brought in some quirky stuff too, so I don't know if I want to cover that. We might not have time with 3 guys. But
That's okay. But I was thinking about the kind of questions we want to ask Tony.
Yep. So I'm going to ask you now.
This is yours, right?
Yeah.
You have 2? You brought 2?
I brought a bunch of stuff.
Yeah.
What?
Go ahead. I've got some stuff
Oh,
too.
I
so-
thought you said you didn't have any.
Oh, no,
No,
no. Okay, no, I do. I always bring it. I brought some notes, but I don't have any. This is my stuff from last week. I don't have anything from Toni. You have Toni's questions, you said?
Yeah, I forgot to ask her ahead of time, so we're doing it right now.
I'll ask her the Airbnb.
Oh, okay.
Yeah,
The
ask her about
Airbnb.
okay.
Yeah.
Ask about what?
Airbnb. People ask, I've been Airbnb-ing my place, so can I 1031 it now?
Well, the what is an exchange is always
Yeah,
obviously the best.
Yeah, after we do that. I mean,
Yeah.
after we do the basics.
Okay, so the first question is what's an exchange? It's going to be Mark.
You had another one in there that was really kind of more fundamental too that I think would be better as second question.
Okay, too. I was going to ask what the costs were to exchange.
Yeah.
And Rob, do you want to ask like what the rules and challenges?
Yeah, that's fine. I'll fill in like as the conversation gets going.
Okay. And I'll ask about what's a reverse exchange. Mark, why don't you ask about vacation homes? Are they allowed to be exchanged? That
Vacation homes
kind
or
of goes on
secondary
with,
home.
yeah.
Yeah, they're the same.
That kind of go along with the Airbnb question? or is that
Yeah,
separate?
let's do it that. Let's do it in the context of that.
All right. We all set?
Okay.
Everybody has notes?
Mm-hmm.
No, don't worry.
You don't have notes because you're the professional.
We're,
Oh,
yeah,
that's
we're
me.
professionals.
Yeah.
Is that better?
On mine.
1, 2, 3, 4.
Okay. So Tony knows to
And
do
a
her
one,
eye
and a
like
two,
that.
and-
Or to pivot. She knows about that.
Have to do the shoulder pivot.
That's it. So it's just a little
I have to do
bit.
that when I go to the gym. So
Okay.
keep your hips straight, pivot your shoulders.
Oh, okay. We'll do our exercises while we're here. It might look a little odd when you put it online, but what the heck?
It'll play. Okay, you ready? Here we go. Welcome. You're listening to The Best of Investing on Talk 910. I'm your host, Edward Brown, and I'm proud to have as my co-host Mark Hanf of Pacific Private Money, one of California's fastest growing mortgage investment firms, and Rob Spinoza of RPM Mortgage. Our phone number is 888-912-1190. Use that number to answer the trivia questions for 3 vacations given away during this show. The vacations are not sponsored by the radio station, but by Lighthouse Resort Marina, located 1 hour northeast of San Francisco. Those vacations are free. Their only request, a $75 cleaning fee to cover the housekeeping expenses. And in honor of Easter that's coming up in a month or two, today's trivia theme is Bible trivia.
Oh, great.
And
Edward, you're gonna win all your own questions.
Yeah.
Can I get out of this one right now?
I have to win. I have to because if I come up with the questions, I got to know the answers. I can't just say I don't know, right? Okay, our website is bestofinvesting.com. Check us out on television, Comcast channel 26 and AT&T 99, channel 99, Saturdays at noon, Sundays at 6 p.m. Today we have a special guest. Now this is going to be a little more sophisticated than our average bear. All right, we have Toni Esposti, who's going to discuss tax-free exchanges with us. Toni, welcome to the Best of Investing.
Well, thanks so much. I look forward to answering any questions you may have.
So Edward, you introduced her as someone who's a specialist in tax-free exchange. I've always heard the term tax-deferred exchange, and I've also heard like 1031 exchange, and of course we're talking real estate today. Tax-deferred or 1031 exchanges when it comes to real estate transactions and selling real estate. So Toni, could you tell us what is an exchange and why do people do it?
Well, what an exchange is, when people own investment real estate, when they go to sell it, if they don't do an exchange, they're going to pay full capital gains tax. And that tax can be anywhere between 25 and 42%.
Ouch.
Depending on...
Yeah, because they're not getting the primary home capital gain exemption if they're single or married.
Exactly, exactly. So if people own investment real estate and their intention is to continue owning investment real estate, they can structure it like a tax-deferred exchange, which is how we refer to it. And if they do that, they can take that money with them. And I look at it as an interest-free loan from the government that you pay back when you feel like you want to pay it back.
I don't want to ever pay it back.
Well, we've actually got an answer for that.
It's called San Quentin.
We have an irreverent phrase in the industry, it's swap till you drop.
There you go.
There you go. See, tax evasion is illegal, but tax avoidance is not.
That's right.
So this is a tax avoidance thing.
So tax deferred, what is it? So what does that mean? How long are you actually deferring it to when you conduct this 1031 exchange?
Well, you defer it until you ultimately down the road liquidate an asset. So you can exchange out of a property into another one after a few years, do it again and again and again, and that's why we say swap till you drop. So if you exchange until the end of life, when you pass away, there's a step up in basis to current market value. So your heirs could sell the property close to the value at the time of death and have little to no tax.
You know, that's a very
really,
good point about that step up basis. And wasn't there some talk about some rule changes that got like they didn't get in place?
Well, there's
that's a word.
Well, it's not a matter of rule changes, but what's been happening up on Capitol Hill is they've been looking at eliminating exchanges.
They can't do that. That'll put you out of a job.
Well, that's why we always like people to write into their
That's right.
congressmen and
That's right.
senators.
Person after my own heart. That's
Yeah.
exactly right.
Well, if you eliminate the exchange, that would really be the worst case scenario for people who have conducted one or more exchanges over time. Because I know my father was a real estate developer and he loved to use the tax deferred exchange. But what ended up happening for him is when he reached into his 70s and he wanted to liquidate properties and utilize that cash elsewhere, he really couldn't because he had very little basis in the properties.
Right.
And let's say he sold a property for $1 million, but he had virtually, maybe 100,000 or maybe even less tax basis.
Right.
So now he's selling it for $1 million and paying profits or taxes on $900,000 worth of profits.
Well,
it's really,
as Toni said,
it's a hard hit.
It's like an interest-free loan. But the thing is, it wouldn't just put someone like you out of business. It would really hamper a lot of the real estate agents because there'd be less activity. I mean, it goes down the line.
Yeah, it does.
They've done a big economic study on it to see how it would impact the economy, and it would be a net negative to the economy.
Of course.
They were trying to raise money to pay for corporate tax
Gotcha.
reductions, and it really will not accomplish what they expect that it will.
Okay, so if somebody, I guess what's the procedure? Somebody says, okay, I want to sell my property, but I don't want to pay tax, so I want to exchange it, and you handle the facilitation of the escrow?
Well, we don't handle the facilitation of the escrow. We handle the exchange portion. So what we do is we educate people about the exchange process, what the rules are, what they need to do to be successful.
Okay.
And then we create all the legal documentation that supports it as an exchange that's required by the IRS safe harbor provisions.
So it's kind of a two-part question. One, what specific things do you educate people about what they need to do? I know there's things called boot and all that kind of fun stuff. Boot camp. And then also, how much does it cost for your services?
Well, I'm going to go backwards on you.
Okay.
I'm going to tell you what it costs to do an exchange. You're probably looking at somewhere between $1,100 and $1,200 if you're just selling one property and buying one property, and you're selling one property first and buying another property second. We also do a thing that's called a reverse exchange, where someone may buy a property before they sell a property. That's a more expensive type of
Right.
exchange, and that can run upwards of $5,000.
Well, why the difference?
More risk.
Because $1,200 is very reasonable for.
Yeah, incredibly,
Yeah.
even compared to regular escrows.
Yeah. So why so much difference in price for the reverse?
Well, with a reverse exchange, the IRS allows someone to buy a property before they sell a property, but they don't allow them to own both properties at the same time. So what happens is when we step in, and we actually have to physically take title to one of the properties.
Oh, okay.
There's liability chain of title for us.
Yeah.
We have to get our attorneys involved in drawing the documents.
Stop right there. When you get attorneys involved, the price goes up.
So Tony, how did they come up with the term exchange to explain this procedure?
Well, originally, when exchanges came about, and this is back in the 1920s, what happened is it was really just a swap of properties. So one person owned maybe a farm and somebody owned a ranch and they wanted to switch properties. That was the only way you used to be able to do it. And so they looked at it as an exchange of properties.
Got it.
I remember in the 60s when my father was doing exchanges that he needed to have an actual person be the buyer or the seller, and he used to use the term, put a straw buyer up front and then they exchanged property. So it always seemed so convoluted, and I couldn't understand why they ever did it that way.
That's because in the 60s you were about 8 years old. That's why you couldn't understand it.
That must have been it.
Oh, we're going to get into the biblical thing now, right?
Well, I'll tell you,
Or it's not that.
at that time, it actually required the participation of you used to have to do the transaction at the same time. So if you were buying and selling a property, those transactions had to
Oh,
close
I
at the
see.
exact same time. We used to have to
Oh, yeah.
actually call the recorder's office and schedule a time
Oh, wow.
for it to work. And then the seller of the property you were buying would actually have to go into title on your property, and then they would sell your property to your ultimate buyer.
So that's why you
Wow.
needed another person in the mix. But nowadays, it sounds like it's much more simplified. So let's say I own property today. I want to sell it. I don't want to pay taxes on it, and my goal is to buy another property. So I want to, exchange into it. Is what I hear a lot of people say using that terminology. How much time do I have when what's the procedure? There's a couple of different numbers of days that are involved, I guess. There's a time limit, and how does that work?
Well, first of all, it is much simpler now. It's really just like buying and selling real property. The challenge, and the most challenging part of the exchange, is the timeline. From the date someone closes on the property they're selling, they've got 45 days to identify in writing the property or properties that they want to buy.
Wow.
Now, they're not required to be in contract on a property in order to identify it, but honestly, they
It
want
helps.
to be
Yeah,
able to.
right.
Yeah.
45 days is not a lot.
I know.
And in this environment where there's very low inventory, that's got to have them scared out of their skulls.
Just give a map of California and say it's just somewhere in here.
Yeah.
Well, there are restrictions on how
Yeah.
many properties you can identify as
of
well,
course.
but
Wow.
I always say you want to be in contract with inspections done, because once you go past the 45th day, you cannot switch properties for any reason.
Oh,
Okay.
wow.
Okay, we're going to cut to a commercial break. In fact, I'm so old that we used to just here's a couple of chickens and a goat for a pig. Okay. Okay. So here's our first trivia question. Again, we're talking the Bible here. All right. What is the shortest verse in the Bible? And I'll give you a hint. It's not "I am what I am." That's what Popeye said. All right. Okay. So call 888-912-1190. That's 888-912-1190 to answer this biblical question. What is the shortest verse in the Bible? Stay with us. You're listening to The Best of Investing. We're going to be right back. All right. Write that down. Good job, Tony.
Yeah, that's
just try to stay as close to the mic because I'm having to do a little adjustment. All right.
You're asking a an Italian to keep her head straight.
I
I think that's a little much.
I like that.
So we've had guests on before that they just, no matter what, they just insisted on sitting back and trying to
Yeah.
talk into the
Or they kept going like this all the time, and it just. In fact, I got one guy who comes on our sports show. He's a sports agent, and I can't for the life of me get him.
Put a lapel on him.
Put a what?
Lapel.
Oh, well.
Get one of those dog cones.
That's
That's-
exactly what I was thinking.
I know. I was gonna staple him to this thing. You know.
Staple his lip on.
That's it. I was telling Tony that we had Bobby Evans on from, he's now the general manager for the Giants. I think he's kind of took over for Brian Sabian.
Right. Oh, nice. That's good. So activity still pretty strong?
It is. It's slowed down this year. Last year it was just on fire. This year it's really solid. So good volume.
So we can continue on the timing questions. We talked about the 45 days or is the
Yeah,
second
yeah,
one,
Yeah,
just
because
how long
you're
you
gonna
have
ask about the
180.
rules and challenges.
Yeah.
Okay. All right. Ready? All right. And away. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hoff and Rob Spinoza. When we cut to the first commercial break, we asked this biblical trivia question: what is the shortest verse in the Bible? Anybody?
Lots of blank stares here. Nobody went to
In the beginning.
Sunday school.
In the beginning.
period.
Actually, that'd probably be the second one. You know? No, because in the beginning God created heavens and earth. No, Jesus wept. That's one of those typical biblical questions there. Okay. Before we get back to our guest, Toni Esposti, want to mention really quickly at the Lesher Theater in Walnut Creek on February 27th is going to be a tribute to the Beatles. Like Mark and I are going to go to that.
Yeah.
What are they called? What are they called?
It's not Beatlemania. It's
Okay.
just some kind of a tribute band.
That was a great one.
Tribute
The
to
kids
the Beatles.
tell us. They were
Yeah.
wonderful.
And if you've never been to the Hoffman Theater at the Lesher Theater, it's kind of a combination of a very nice venue. So check them out. Go to the Lesher Theater online and see who else is playing. In fact, they're doing a Pink Floyd concert tribute band on March 12th. So that would also be fun. But I'm not into Pink Floyd as much as the Beatles, so I will just go to the Beatles one. All right, so now we have in our studio here Toni Esposti, who is discussing, and I'll correct my terminology as Mark correctly pointed out, tax deferred exchanges, because theoretically, eventually you pay the tax on it.
So in the last segment, Tony, you were mentioning how, first of all, that conducting a 1031 tax for exchange, thanks to companies like yours, is so much easier today than it was decades ago. But we talked about some of the time constraints. So you have 45 days to identify the property that you're going to exchange into, as it's called. What's the other time deadline that's involved in that process?
Well, the other timeline is the closing period. From the date you close on a property that you're selling, you've got 180 days to close on one or more of the properties that you identify in that first 45 days. Now, that's generally easy as long as you are in contract with inspections done within that 45-day period.
Now, what do you find on the question we get asked a lot on the home finance side of it is if I sell a property and I net, let's say $500,000, how much, if not all, of the 500 needs to go into the exchange or out of the exchange?
Well, to some degree, it's discretionary for the exchanger, but if they want to have minimal capital gains tax, they need to put all of the cash that's coming out of the sale of the property into the new property that they're intending to buy. They also need to replace any debt that they paid off on the property that they're selling by getting either a new loan on the property they're buying or by bringing in cash. Cash can replace debt when you're doing an exchange.
Okay, so that's their equity basically in the new transaction they're exchanging into. In that case.
No, it's equity plus the cash equivalent out of the pocket.
Right. Okay, got it. That's what
Sounds complicated, which is why you need someone like Toni Esposti to help you with
well,
that.
we think of it the opposite way, which is that's why I asked the question because it's in that case it's reversed almost from our standpoint. It's interesting.
So in other words, if I have if I sell a property for $1 million and I've got, let's say, $250,000 for a loan against it, so I'm getting $750,000 to to have a tax-free exchange, I can't just take that $750,000 of cash profit, or cash proceeds rather, and buy a property for $750,000 all cash and have that be a tax-deferred exchange. I need to actually buy at least $1 million worth of property or more with and have that same debt structure or a greater debt structure. Is that correct? Kind of, sort of.
Basically.
Kind of, sort of.
What I'm going to tell you though is that could you buy a property for $750,000 and still get a benefit from the exchange? Yeah, you could.
Right.
Oh, right.
However,
There would still be a benefit.
Yeah, because your
However-
basis might be $100,000.
Exactly. So if you didn't replace the debt of $250,000 and you only bought $750,000 worth of property, then you would pay capital gains tax on that $250,000
Right, understood.
worth of
So you
debt
can do
relief.
tax planning is basically what it sounds like. It doesn't have to be all or nothing. You could do a portion of it.
Right.
Correct.
And someone was going to ask the rules about vacation.
Yeah, one thing we see a lot of these days is people are renting out their properties part-time and through Airbnb. And what do we know, I'll step back a second. In finance, residential finance, we have only 3 property types. We have primary, secondary, and investment. So tell us a little bit about how a second home would be distinguished from an investment in the case of an exchange.
Okay, well, if somebody has a secondary home or a vacation home that is strictly their personal use,
Right.
technically that is not considered investment property and it does not qualify to be exchanged.
Okay.
So if somebody owns something like this and they go to sell it, they're going to pay full capital gains tax
right.
unless they do some advanced planning.
Like moving into it.
Well, they could move into it, but there's some drawbacks to that I'll explain in just a bit. But one of the options that a lot of people will use is they will convert it either to a full-time rental,
Got it.
or they will convert it to a vacation rental. Now, a vacation rental still allows you a little bit of personal use of the property. There are certain safe harbor provisions. You have to look at the 24-month period prior to exchanging a property. And they break it down to 2 12-month periods of time. And in each 12-month period of time, they need to have rented out the property at fair market rent for at least 14 days.
Okay.
That's really easy.
Okay.
But they also have to restrict their personal use to 14 days in each of those 12-month periods of time, or 10% of the time they rent out the property, whichever is greater.
Wow. Okay. So yeah, you really need to get down to the planning level to make it work. I mean, it's not something you take lightly and just fall into an exchange and say, hey, I've got this second home. I'm going to rent it out for a couple of days and then I'm going to call it.
I'll bet you work really well with the CPAs. You get a lot of calls from them.
Yeah, we work hand in hand with CPAs whenever
Realtors,
necessary, yes. The thing that Rob mentioned about, well, you could just move back into it. Well, that used to be a really good strategy, and it's still a good strategy, but it's changed a little bit. They changed the primary residence exclusion rules. When you own a home that you live in, and you've lived in it for 2 of the previous 5 years, you are entitled to have a primary residence exclusion, which is $250,000 if you're single, $500,000 if you're married filing jointly.
Right.
Well, a few years ago, they kind of changed that. That would be January 1st of 2009. And they said, you have to live in it for 2 of the last 5 years, but you can only use the primary residence exclusion for the ratio of gain that corresponds to the ratio of time that qualifies as primary use.
That sounds like math.
Yeah.
It does. So
Several cars just swerved off the road. I gotta think this one through.
you make exchanges so much more fun than it really is.
I know, it's like people say, don't text and drive. Don't do math and drive.
That's right.
Okay, so
No, but I don't think people think they just don't consider. They hear 1031 bandied about, and they don't think about all that, and they've got to ask a professional. Just like anything, most of the stuff we talk about on the show is you can't DIY any of this stuff. Really, you got to talk to people who know it.
You can't what?
Do it yourself.
Oh,
DIY.
Oh, not DUI. Okay.
You can't DUI it either, Edward.
Hey, I only drink to excess. No. Yeah, you know what, Tony? You've got a lot of good information here, and there's probably people driving around, hopefully, who haven't hit trees because of the competition. How would they get a hold of you if they have any questions about tax-deferred exchanges?
Well, I'm with Older Public Exchange,
Okay.
and I have a toll-free number. It's 888-677-1031.
1031.
1031. So they can either call you and bug you.
Yeah. Thanks.
Well, since they're doing that anyway.
Yeah, great.
Or they can try writing while they're driving.
Yeah.
I want to vouch for Old Republic though, because I've
Yeah.
used them extensively throughout my career, and the quality of individual there, Tony included, is just field leaders really. So you guys do a great job.
And is it like a sister company to Old Republic Title?
Yeah, we're a sister company.
Okay.
We're owned by the same parent company.
All right. Well, tell you what, stay in the studio here because when we come back, we have a tricky question here for Mr. Hahn. People are going to want to know, what is that tricky question? All right. Going to put him on the hot seat. Okay. Also, you know what I wanted to mention before we go to break? Also at the, it's not actually at the Lesher Theater, but it's in that area there. It's actually called the George and Sonia Vukasin Theater in Walnut Creek. It's the same, basically it's the same address, and they're doing something called Pageant, and it's this show where the audience gets to be the judges. So it's really kind of cool. You got to check them out. Again, if you go to Lesher Theater in Walnut Creek and go down the list and look for Pageant, you'll see it. It's very interesting. Okay, let's see here. Second commercial trivia question about the Bible. This one's a tough one. Yeah, like the other ones are easy,
Like
right?
that one was easy.
Well, you guys got to get back to the church. Okay, in the Bible, there's only one place where scholars believe is the only time God says, "Test me." Right? You're not supposed to put God to the test, but there's one place where scholars believe this is the only time that he said, "Test me." In which book of the Bible is that? Right? There's 66 books. You have 66 chances here. All right, the first caller with the correct answer wins a free 3-day 2-night stay at the Lighthouse Resort. Call 888-912-1190 to answer that question. Stay with us. You're listening to The Best of Investing. We'll be right back. A little bit over that. That's fine. You did good. Yeah. Okay, so your tricky question here is, at what point is it break even if I wanted to get out of your fund within 2 years, as I've heard you mention on the show, mentioning the early withdrawal penalty?
Break even.
And Rob, you know yours, right? As a buyer, how do you recommend I compete against a cash offer?
Yep.
Exactly. So did you have fun? See,
Lots of fun. You guys are a party all by yourself.
We try to be.
This is a great topic, though. I'm seeing more and more 1031 stuff. I mean, just
it's hot right now.
yeah.
It's hot.
Well, you know what? I talked to my financial advisor. We were going to list the property we have, an investment property for sale. He's like, "Don't do it." It's like 1031. Eventually, not now. Whatever. 1031.
Do you
really
guys
start thinking about it?
refer to any services for people who are desperate? They fall out of an exchange, and I've heard that you can go into a REIT or something and that qualifies. But
Well,
are you even able to?
Doesn't qualify.
Not anymore.
Qualify.
I thought REITs did.
well, a REIT does not qualify because it's ownership of shares in an entity.
Yeah.
But there are things that are called DSTs, Delaware Statutory Trusts, that are REIT-like properties, and
That
you
must
can
be because
exchange
I heard
into an
there was a
interest.
product that you
Yeah.
could, if all else failed, you can go.
So
to
can't
the hard
identify the
right,
property.
Put your money over here.
Can't identify the property. Can't close it in 180 days, and you got to
Well,
do something.
Well, you
Basically.
have to identify within the 45 days to be
Yeah.
able to go into one of these things, but they generally have a lot of prepackaged things ready to go. So if you're in cash,
Right.
they can show you some product and they match it up with your debt load and.
Or you could always quickly go into something and then exchange back out of some,
No, because there's a holding requirement.
Oh, that's right.
There's
that's
the
How long?
qualified use requirements. They just say for a period of time,
Reasonable.
I thought it
but
was a year.
you
wasn't
know,
it?
thank you IRS, we don't
Right,
have
right.
a definition, but most CPAs these days are gonna tell you that probably 24 months is the safe
Wow.
timeline.
Wow.
Wow.
They say the safe timeline because there are a couple of revenue procedures dealing with
Okay.
timelines that talk about 24 months.
Okay.
I still hear CPAs say
Rev
1
proc.
year if they're,
Yeah.
1 year if they're a little more aggressive.
Yeah,
but
because capital gains.
24
would be
months
when you're-
being the safe
Gotcha.
timeline.
All right. Yeah, excellent. So stay with us and feel free to ask questions, when we get this.
Okay.
Here we go. Okay. We always teach new business. I gotta give them 5 seconds of silence here. Okay, ready? Well, welcome back to The Best of Investing. Edward Brown here along with Mark Hahn and Rob Spinoza. And that math was just killing me during the break, but I'm back now. I'm
Smoke
awake.
is still coming out of Edward's ears.
Yes, it is. Okay. Hey, I'm gooder at math than most people. All right, but here's our second trivia question about the Bible. There's only one place in the Bible where scholars believe is the only time God says, "Test me." In which book?
That would be the Sorcerer's Stone. Oh wait, that was Harry Potter.
No, it's in First Opinions. No, no, Malachi, or Malachi for those who are not familiar.
Not Ecclesiastes.
No, the Ecclesiastes is one of those ones that you just, if you want to get depressed, read Ecclesiastes, along with Lamentations. All right, so how do I know all this stuff? Okay, Mark, we have a trivia. We have a question. This is going to put you on the hot seat, right?
Email question. Huh?
Email question.
All right,
yeah.
good.
Listener writes in and says, at what point is it break even if I want to get out of your fund within 2 years, as I've heard you mention an early withdrawal penalty?
Oh, okay. So that question is aimed towards the Pacific Private Money Fund, which we've talked about at this show a lot, and it's a form of mortgage investing, and people who are members of that fund right now are enjoying a little over 8% annualized yield on their investment. We've achieved that yield for 3 straight years now at the Pacific Private Money Fund. And so we do, for new investors, we do ask that they keep the money in there for a certain period of time. And that period, we ask that you keep it in for at least 2 years. And if you keep it in for 2 years, there's no load on that investment. There's no fee to go in and no fee to get out. They call it a no load. So that means if you invest $100,000, all of that money goes to work for you, and then when you're ready to redeem, if you've been taking monthly distributions, at the end of that, whatever term that is, you get $100,000 back. And during that time period, you've earned the yield on the fund, which, as I said, although past performance is not a promise of future results, but we're pretty darn sure we're going to continue to achieve those results based on the demand that we have for our privately funded mortgages. So the question was the early redemption fee. So we have a declining redemption fee, and the actual break-even point is right around 6 to 7 months right there, because in the first 6 months, if you have to take your money back out again, we will charge a 5% redemption fee. In the second 6 months, that drops to 4%. So presumably, if you've had it in there for 6 months and you've earned approximately half of 8% or about 4% on your money, and you need to redeem in months 6 through 12, in that time period, you would get a 4% redemption. So it would be kind of a break even for you. So it's designed not to be punitive unless you take your money out right away within the first 6 months. But if you leave your money in there for at least a year, you're going to be money ahead. After a year, it drops down to 3, and then the last 6 months of the 24-month period, it drops down to 2%.
So if you're in just a little over a year and you've earned, so let's just say 8%, and then you get out, and there's a 3% penalty, you're still plus 5%. That's just a little better than the bank, huh?
Just a little bit, yeah, a little bit on that 1/4% you can get on your money market.
And you can't even lean on the stock market now either. I mean, I think a lot of people, if you had asked this question back at this time in 2015, people would be like, you know what, I'll take my chance at the stock market. But they're not saying that right now.
Now keep in mind too that I have dozens of investors who have already been in longer than a 2-year period, and they can add money and take it out like it's a money market account. Now, I prefer that they didn't, and so far nobody is behaving in that way. But you could potentially, after 2 years, we don't reset the clock every time you add money. The 2-year clock starts the day you open your account. Let's say you open it with a minimum investment of $50,000, but over time maybe you add another 50, another 50. In fact, I've got several clients who've added 5, 6, 7 deposits and have increased it over time. After 2 years, you could park money in there for a short period of time. Maybe it's $20 or $30 or $50,000, and
that's a very good point.
So it is. It can be. You can treat it like a money market account after 2 years, but really the goal of the fund is to create a pool of money from which we can fund short-term mortgages in the Bay Area for people who need a Plan B when Plan A fails, and it happens more often than you would think. And so we're doing a lot of bridge loans these days for people who want to quickly buy a property to move into, and they find out from their banker or their mortgage guy that they don't qualify for a second mortgage because of all the new ratios they have these days, thanks to Dodd-Frank. So we actually do quite a few short-term purchase money bridge loans for people. There's no prepayment penalty on our loans, so if you need the money for 6 days, 6 weeks, or 6 months, it's an option for you that people can take advantage of. The money's not inexpensive. We charge our borrower clients about 10%, which is how we're able to provide a slightly above 8% yield to our investor clients. So,
right.
But it's there for it's there for the asking. It's an option for you if you're going to lose an opportunity to buy a property and you want to close quickly. We have both speed and stealth and ease of being able to qualify for the money going for us, and oftentimes that makes up for the cost.
And
you get the property you want.
You're quite established now too with this fund because it's been around for over 2 years. And how much money's in the fund?
Yeah, nearly 3 years. We got 15 million. We're just about to crack that. I've got a commitment coming in that'll crack the 15 million mark, and we're intending to grow the fund to about 50 million, which would be more. We have deal flow that's more than adequate for that deal, that size fund. So we're pretty excited about how well received it's been and the speed at which it's growing.
Good. Any special deals that of the week type of thing?
I forgot to tell you before the show. Don't ask me that question.
Okay, sorry. Oops.
Well, actually, no, that's not true. I do have one, and actually, this is one that we did a year ago. That's come up for renewal or maturity rather, and I really like this property. And I thought maybe the existing investors, along with the fund that's in this loan, would want to re-up, but it turns out that this group of investors who kind of invested together, they actually want out. And it's approximately $1.5 million on a property that is a commercial property in Mountain View, right across from where Google has their main complex, as well as Microsoft. And in fact, this particular parcel of property is right next to a building that Google also bought, which is some kind of satellite imaging company. Anyway, the guy bought the property. We helped him buy the property a year ago with this money, and the comparables in that neighborhood have just shot up. So he's got the appraisal on that approximately 1 acre of land right now is about $5 million, and we have a $1.5 million first position loan on it. So I don't think I'm going to have trouble attracting capital for. He'd like to have another year, and so I don't think I'm going to have trouble attracting capital for short-term refinance of that.
What's the interest rate you're charging?
I think on this one was about 10.5%.
Okay, so 2 quick questions. One, why do the investors not want to re-up? And also, why can't you get conventional?
It's so I like the loan.
Yeah,
as a fund manager, I think the
yeah.
loan is very safe. Now, the group that's in there is nervous about what's happening in tech.
Right.
And Google notwithstanding, and Google's not about to go out of business, they're nervous about the headlines. About being in a tech bubble and that we're in a tech correction, which this is their term, not mine, because I don't necessarily believe that's true. Because while some tech companies are finding it difficult to maintain valuations, that doesn't mean that we're necessarily at the precipice of another tech correction.
How is that building? How is it zoned? Is it industrial or what is it like?
It's zoned for an industrial type building, and he's already got the plans. He's going through not the city council, but there's another organization in Mountain View that has already greenlighted the project. So he's got the formal approval forthcoming. It's not in hand yet, but all signs point to him getting approval for it. Once he has the approvals, then he's going to get a construction loan and pay off our short-term loan. So
But is it? How many square feet is it?
The lot is 37,000 square feet.
Okay.
I don't recall exactly how large the building is. It's probably about 10,000 square feet. But anyway, for more information on investing in what we call mortgage investing or mortgage pool fund investing, or if you are interested in, or at least would like information about how you can acquire a short-term loan for a property acquisition or even a refinance of existing property, give us a call at Pacific Private Money. We're at 415-883-2150, or go to our website, which is probably the easiest way to get information on our products, pacificprivatemoney.com.
Very good. Okay, we're going to cut to our last commercial break here. The hour goes quickly. I want to make a quick announcement here for the Purple Orchid Wine Country Resort and Spa, as it stands out among many hotels in Livermore. I never realized
Orchid.
Purple Orchid. Yeah, I never thought about Livermore and wine country, but apparently it is. Enjoy, get this, private fireplaces, jacuzzi tubs, and delicious breakfasts during your stay. They also guarantee guests with relaxed and rejuvenated, that they'll get relaxed and rejuvenated during their visit when they take advantage of the extensive spa. I'm there, baby. Take in the natural beauty of Livermore Valley and enjoy the many local wineries or taste some of the delicious restaurants in the area. There's something for everyone to enjoy during their stay. www.purpleorchid.com or call 925-606-8855. That's another easy phone number to remember. Okay, here is our last trivia question, the Bible. You guys better know this one. Which biblical person killed thousands of Philistines with the jawbone of an ass? Can I say ass on this show? I think I can. 888-912-1190. Stay with us. You're listening to The Best in Investing. We'll be right back. Right on the mic.
I think you did just say
Yeah,
that.
One time I had
Is your
someone.
last name Hanf?
It is.
Horst Hump?
Mm-hmm.
Is your father?
Yes.
Okay, because I used to handle Horst
Yeah.
and Gerardo's
Yeah.
stuff. I remember
Horst and
you because you were working with your dad at
I
that
was,
time.
from 82 to when the company didn't survive. In
All of a sudden, it
2006,
just finally clicked
Yeah.
for me, and I went, "Oh,
Yeah.
geez, now I know who I'm talking to."
Yeah, so Dave Kenyon did a lot of spearheading
Yeah,
the deals.
I do a lot of work with Steve Gerardo
Mhm.
to this day.
Yeah,
So
yeah, I still I don't connect with Steve and
Dave,
Dave much. Dave probably more. I just
Yeah.
because he still does some legal work for me.
Yeah.
Steve and Jerry.
Yeah.
Are pretty. They're busy guys. Got
Some
a big
other
firm and they got their real estate arm and
yeah. You got 2 arms.
yes.
Yeah.
Yeah.
Busy.
So,
So, what are your upfront points on your money?
it's we're doing larger loans because everything's transactions are all $1 million up there. So typically 2 points, 9.9 to 2 points
Okay.
with a doc and proc fee depending on the complexity of the deal, ranging from 1,000 to 2,000.
Did you? I purposely didn't say anything during the show. Did you want me? The email you got last night about the Schwab thing?
Let's talk about that next time. Yeah,
That next time meaning
next week.
Next week.
Yeah,
Okay.
let's talk because I
Because
need to. I want to have that with me.
Because he's got a QSIP number for Fidelity, and now it looks like they're qualifying for Schwab.
It looks like the fund administrator just sent an email out to all the funds that it helped create and administer, saying that they've been able to. There's an organization, I guess, for alternative investment strategies, so that you can be approved for Merrill and Schwab and all the other.
It doesn't have to be an IRA with them, right? I mean, it could just be money that you have just
Exactly. Yeah, it's just right money that
Which
they
is
have.
great.
Because they all now have alternative investment divisions
Yeah.
for stuff like this.
Yeah, because too many times someone says, "Oh well, I deal with Merrill, but Merrill says I can't do it."
Right.
It's like,
Yeah, that'll be really cool.
okay.
Very cool.
All right. I'm just gonna make one quick mention here, and then we'll go right to your
Sure.
Well, welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host. I'll be Edward Brown all day, but this is the last time for the show. And along with Mark Hahn and Rob Spinoza. And when we cut to the last commercial break, we asked this trivia question: which biblical person killed thousands of Philistines with the jawbone of an ass?
That was easy. Samson.
Yeah, Samson, that is correct. You are the biblical scholar, my friend.
One out of 3 anyway.
Yeah, not bad, not bad.
Hall of
Just
Fame.
just a quick mention for our friends over at Pacific Trade Exchange, barter to barter business. So you're talking about tax deferred exchanges with Toni Esposti and Old Republic Exchange. This, Pacific Trade Exchange does business to business barter. Check them out at pacifictradeexchange.com or pactrade.com. Okay, Rob, question for you we received from a listener. It says, as a buyer, how do you recommend I compete against cash offers? That's a good question.
Good question. Tough question. Before I get started, Mark, I wanted to tell you I almost had exactly what you were talking about before. I had a tax return that was so complex on a single-family residence. Parents were buying a home for a son, and they had trust income. They had 24 partnerships. And I had a level with them right at the beginning and say, this is going to be a lot of fun for you guys. Anyway, they ended up buying the property all cash. Their other method was going to be a private money.
Yeah.
I think it's something that, and so getting back to kind of tying the whole show together here, let's say you have somebody who wants to compete all cash. or they're competing against an all-cash offer. They can do any number of things. Fortunately for our industry now, most of the large banks, and RPM included, have gotten wise to it, and we have an advance approval. So basically what happens here, a buyer goes through, they get pre-approved for a home loan. We go the extra mile. We actually fully underwrite the income, assets, and credit. We issue them a guaranteed close. So in 25 days, they'll be done. The only things they need and the only risk points they have are the appraisal and the title work. So as long as they have that in their pocket, they can now go out and offer to the seller aggressively as if they were a cash offer. Where they can get some leverage against the cash offer, hopefully in this environment, is that a lot of cash offers go in knowing they're cash offers and just assume that they can name their price. A financed offer, so long as the appraisal holds, may enable the buyer to actually offer a little bit more than an all-cash offer. So that's really what we're seeing as being the edge, and I think it's important to note that if you're a buyer out there, you cannot be dissuaded by what other people offer. You can only put forth your best offer, whether it's the limitations on your financing, the limitations on the cash you have available yourself, whatever it may be, you can control what you can control. You can't control the other offers. So I think, especially now in an environment where we don't have a lot of inventory, there's a lot of competition for the few homes that are available. Some people say, well, you know what, I'm not even going to throw my hat in the ring. And I discourage that because I think all we see is financed offers. We do not deal with cash offers on the financing side by definition. And we win plenty of property. So it's worth it to remain optimistic, and hopefully as we go into the spring, we'll see things free up a little bit as well.
Fair question. Very good.
Well, we got a couple of nuggets here that kind of dovetail, Rob, with some of the stuff you talked about. So I pulled this off of the Wire this week. Is the high-end property boom about to end in this market? And apparently, so we all kind of know that the tech sector has helped drive the sales of high-end properties in San Francisco. In many cases, some of those properties are worth more than double what they were trading for back in the last peak of the boom in 2007 and 8. It says buyers of high-end homes are becoming more hesitant due to losses incurred from falling equity markets. Of course, we know all about that.
Yeah. One of the things I see a lot. Yeah, and we're tremendously exposed to it just geographically because of high tech being in our area and constituting a lot of what buyers bring to the table. One thing I've said for a long time now, when you talk about how robust the housing market is, when you start getting into price points that are north of $1.5 million, let's say, a lot of those buyers, those tech buyers, are qualifying with bonus income. Okay, they're not just qualifying off of a base, because really you need both spouses earning, and in order to qualify for financing in that range, bonuses are highly tied to performance, which is highly tied to the stock market. So that's the risk point that I see with those. Now, I will say, when you talk about high-end housing prices, it's all local. Very much so, because I mean, you and I, Tony, have seen here in Marin even what was high end yesteryear. The sweet spot was 800 to $1 million. Yeah. Now that's an entry level home here in Marin. For better or worse.
Does it even give you an inside toilet for that now?
I don't know. We don't see those properties. Ask Mark that question.
Well, from your standpoint, working with the bank, basically,
right?
How do you look at the bonus income?
Yeah.
I mean, now a W-2 won't necessarily show it.
No, you have to break it up. Yeah. Our job has become so much different than it was years ago, because now when you pre-approve a buyer or you fully approve them, the first thing I'll do is order a verification of employment for the borrower, because you've got to nail down exactly what the base income was. And for bonus specifically, you're qualifying typically a 2-year history. And if there's been any change in employment, you've got to assure that they've received bonus in new capacity, new job, in order to qualify anything that happened historically.
But do you guys consider bonus income as just like their regular income?
Absolutely. Again, subject to a lot of other guidelines. Is it increasing? Is it decreasing? Is it likely to continue? Is it what makes up the bonus? Is it restricted stock units? Is it cash? I mean,
well, I remember we had that one issue where someone made $800,000. The next year they made $500,000.
Right.
And even at $500,000, they ordinarily would have qualified, but because it was declining, they got declined. It's almost like they would have been better off making $400,000 and then $500,000.
Right. So disparity in income year to year can be a big piece of that puzzle too. So I think that is one of the things I see as being a risk to sustaining. But as far as demand goes, again, fundamental demand, it's very high, and I don't see that changing this year.
And before I forget, because you answered the question,
Yeah.
How do people get a hold of you?
My bio's on Best of Investing. You can always go to the website. Also, I work out of the Mill Valley office of RPM, visible from the 101 if you're not texting. And you can,
Or
at the time you go by, you're doing it.
Remember, don't text and do math.
415-367-5959, RPM Mortgage is who I work for.
So Rob, there was one other thing a nugget that I pulled off that I thought was interesting I wanted to talk with you about. Apparently there is a growing dominance of non-bank lenders in the mortgage industry as big banks pull away from originations. And the reason I thought this was kind of interesting is because I'm in the private lending business,
Right.
and a lot of guys say, well, I'm going to get a loan from the bank. And so there's this, this verbiage we throw around, is it a bank loan or is it a hard money loan?
Right.
And the term bank loan is kind of meaningless now because actually banks don't make that many loans anymore. So it turns out in 2014, non-bank lenders became the primary source of new mortgages,
Right.
and now we're in 2016. It's actually
That's
the
amazing.
majority of mortgages, and so you're with RPM Mortgage, and so you're considered
We're
a non-bank lender.
We are a
Oh,
non-depository mortgage bank, but we're considered a non-bank lender.
Oh,
So
really?
yeah, people will call me all the time and they say, well, why should I work with a broker and not a bank? And I'll say, well, we're not a broker. We can broker, but we are a banking institution, and 9 of 10 of our loans will be banked, meaning RPM will control them start to finish.
Yeah, so that's kind of an interesting trend that we've had, thanks to Dodd-Frank and making it very, very expensive to make loans, that banks are finding other ways to pad their income and doing things other than actually making loans and mortgages, which is
Right.
one of the reasons they were designed in the first place.
Well, I think the other strong suit for a non-bank mortgage lender specifically is that we have a variety of product where if you go to a single institution, they may do something very well, but if you don't fit that narrow space, then you don't qualify for their loan. Whereas a non-depository mortgage bank like RPM will have a variety of investors and guidelines and more likely to catch exactly the unique characteristics of your scenario. So that's what I find is a big reason that I am associated with a bank like RPM and not a single entity.
Well, what's interesting too, you've been in the business for a long time.
Yeah.
You walk into your local bank, and the person sitting behind the counter there has probably been there maybe a year or two.
Oh.
They're on their way to probably it's a stepping stone position for them. So
Right.
Really, let's face it, the best loans you're going to get are not going to be from your bank.
Okay, I got to tell you, true story. I went into a large bank, not Wells Fargo, because I like Wells Fargo. I went to a large bank, and this person you could tell behind the counter was obviously new. Literally, it said, pay the order of Joe Blow. And this person could not figure out whose account it was supposed to go into. I'm serious. And then the manager was stepping behind, basically had kind of, she kind of looked at me, and I tried to, she goes, oh, I knew. And I said, oh, it's okay, you're doing just fine. Make sure it gets in the right account.
So Rob, with mortgage rates back in the 3s again,
Yeah,
which
2.5
no one thought was
years.
going to happen,
Yeah.
how was refinance activity?
Definitely,
in your office?
refinance activity has picked up, and that's a good thing. And I think everybody, even if it weren't only rates, I strongly encourage that all borrowers take a look at their loan at least once a year.
Yeah.
Beginning of the year is a good time to do it, but you're also going to be filing your tax returns. Another good time to be looking at the 1098, which shows your mortgage interest, and saying, is this as good as it could be? Are there any other strategies that would help?
One thing, and this would probably be a question someone would ask one time. Sometimes I know that people, they look and they say, oh, I don't want to refinance because I'm paying so much principal towards, the loan
Right.
because it's 7 years into a 15-year
Right.
mortgage. And the thing is, it's like, yeah, but if you're paying 6% interest, I said, there's no prepayment penalty for
Yeah, so-
making extra principal payments.
So what you want to
You
do
got
in
30
those,
seconds. Go
okay,
ahead.
what you want to do in those cases is you want to look at a refinance the loan, continue making your existing payment. Then what you do is you reduce your interest exposure, but you continue to make principal.
Yeah,
at
as long as you don't have a
accelerating
bunch
clip.
of, quote, garbage fees that eat
Exactly,
it all up, you're
exactly.
very, very smart. Okay, Toni Esposti from Old Republic Exchange. Thank you very much for
Great job,
joining
Toni.
us.
Thanks for having me on.
Okay, so here's our thoughts for the day. These are biblical proverbs for the day this time, all right?
Since we cleaned up on the
Okay,
trivia.
Tony, cover your ears for this one. It is better to live alone in the desert than with a crabby, complaining wife.
That's from the Bible.
That's from the Bible. Yeah, I guess.
Wow.
That must be the new version.
Well, they must be talking about the guy who's married to one of the Kardashians. And then another one is, now get this: give beer to those who are perishing, wine to those who are in anguish, said the man with the grabby wife. All right, tune in next week to The Best of Investing. We're going to be giving away more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long. Excellent.
I'm anguished.
So
I'm famished.
I brought an article. We'll get on it next one.
Okay.
We touch